uranium is the single best setup in the world, I believe, for any commodity because the demand side is so overwhelming and the supply is still so constrained. It's idiocy that we've seen not just look, when you go from $18 a pound on uranium 5 years or so ago to 105 or 6, whatever it was at the peak early in 2024, okay, that was a nice run. You're bound to have a consolidation, and that's forgivable. We went down to 80, that looked like the bottom, then 70. Lately, we've been more in the mid 60s. That's a gift. In the mid 60s, when you look at the demand setup, and how long it's going to take for supply to catch up to that. Uranium to me is every bit as bullish today at $65 as it was at 18. Because I think, again, and I probably said this to you before, in a couple of years, we're going to see $200 a pound for uranium, barring a global depression that shuts down a lot of economic activity for a while. Because that's just how strong the fundamentals are for nuclear power generally and all of that. Natural gas, I think, is a close second, especially for us here in North America, where we've got the cheapest and some of the best reserves in the world, including up there, of course, in Canada. And the rest of the world is way higher price for natural gas. You're going to be starting to export more gas from Kitimat before too much longer, and that's going to help the market in Canada. I love a lot of the depressed Canadian natural gas producers and explorers, even more so than those I see here in the U.S., quite honestly.
For disclosure purposes, our site does not make recommendations for purchases or sale of stocks, services, or products. Nothing on our site or this podcast should be construed as an offer or solicitation to buy or sell products or securities. All investing involves risk and possible losses. This podcast is for entertainment purposes only. Please read all disclosures and disclaimers at the end of the show. Chris, thanks so much for joining the show. It's been a few months and a new year that we're back on the podcast. I guess we'll just start with the fact that gold is over 3,000. We've seen copper have a run, silver have a run. What are your thoughts so far on this for the year?
Well, the metals, Cali, are moving, but for somewhat different reasons. I think gold breaching the $3,000 an ounce US level for the first time is big news, obviously. Silver is still trying to play catch up. It's getting to an important chart point where it might accelerate because it's looking at trying to get over its highs of the last year or two, where it just gets up to the low and mid 30s and just can't sustain a move. But I think it's the real deal this time. There's a whole lot of reasons for it. And gold for some time now has been moving independent of what else goes on in the markets. All of these historic correlations, whether it's with the US dollar or other asset classes, just don't seem to matter anymore. There's insatiable appetite for physical gold out there, even though the universe of mining stocks, especially the explorers, still, by and large, and I'm speaking in general terms, haven't kept up. There's been some glimmers of life in the recent past, and I think that could become an avalanche under the right circumstances. But we may get a bit of a pause finally this week because I don't see the Fed lowering interest rates. I don't see them throwing much of a bone to those who think they should be lowering rates sooner rather than later. And so that could undermine the stock market again, as well as even commodities. But we'll see. But look, long term, I love gold and silver. I said at the beginning of the year that my three favorite themes, commodity wise, were natural gas, gold, and uranium. And those are still my top three. It probably will be for a while. On copper, Cali, I'm agnostic right now. Copper is not, in my view, gone up for the right reasons. There's been some stockpiling going on, people trying to get some physical copper before more tariffs kick in. But this is happening against a backdrop of worsening economic growth. We may see in the US, when the first quarter number for GDP comes out, a negative print still. So people are looking over their shoulder for that. And I think it's really strange where copper's concerned, where I don't know if we actually did get back above $5 a pound US today, but it was within a whisker of that when I looked a couple hours ago. That shouldn't be going on at the same time that oil is still on its back foot, even with more tension in the Middle East. I mean, that doesn't, like the old robot said on Lost in Space TV show back when I was a kid, this does not compute. So Copper is not going up because people are optimistic about the economy. It's going up because of stockpiling and people trying to get ahead of increased tariffs that may be a couple of weeks ahead. So, short term, I'm agnostic, but long term, the fundamentals for copper are great. And when the tariff stuff is under our belts and, maybe a recession under our belts, it's going to be time to back up the truck on good copper stories. But I just don't like the setup here as I do for gold and silver.
I 100% agree. I'm not quite on the train for copper yet, but silver, especially, I'm a big fan of right now.
Yeah.
Speaking of tariffs, I feel like we have to talk about that. I see positives and negatives. I mean, it feels like we're like a Monty Python skit right now in Canada that we're taking orange juice and whiskey and Budweiser off the shelves as our retaliation. But I do love the fact that we're speeding up permitting in BC and parts of Canada for mining, so that's great long term. As far as the energy sector with oil and gas, what are your thoughts? Do you think that they've even really thought these through, or do you think we'll have to wait till April 2nd to kind of see how this all works out between Canada and the US?
I'm going to look at this first off from the perspective of an American who several times a day lurches from standing up and cheering for the Orange Wonder and then 10 minutes later saying, "What is the matter with you?" And on that ladder, I have to say that I think it's been asinine for President Trump to pick a fight with our closest and perhaps best and most substantial trading partner. When he says that Canada has nothing that we need, that is demonstrably false. Starting with 4.5 million barrels of oil or so a day we get from Western Canada, that at this particular point in time we cannot do without. His idea that he's going to somehow replace that doesn't pass muster because the only place that we would get that kind of oil comparable to WCS would be from a place like Venezuela, which he's trying to shut down and cripple until the right government is in. So this is just silliness, and he is not doing our domestic energy industry any favors with some of these tariffs because when he expects it under $70 a barrel again, any U.S. company to go out and fall on its sword and lose money to increase production that there's not a justification for and do it in an uneconomic way. He's nuts. I mean, what do people think, and what does the president think that people use, companies use to get oil and gas out of the ground? He's not taking all these paper straws that he just outlawed and taking Elmer's glue and gluing them all together and just stick them in the ground to draw up those hydrocarbons. You're using wells and wells casing and other equipment made out of steel, made out of aluminum, made out of other stuff. And he just raised the prices for all that stuff with these tariffs. So look, there's a time and a place for tariffs if you use a scalpel and a surgical approach. This guy, unfortunately, thinks that a lot of bluster and a lot of good intentions are going to make tariff policies that really don't make economic sense right now work. You know, um, Look, in the US, we're going to have the best permitting environment of my lifetime, thanks to the dynamic duo of Doug Burgum at the Interior Department as a super czar of several agencies, actually, and then Chris Wright at the Energy Department. That does not change math and it does not change economics. And until we are in a place where we can replace quickly what we're putting tariffs on, we shouldn't be doing it. Or there should be something a little bit better thought out than what we've seen. So I think it's regrettable what's going on where Canada's concerned specifically. He should have started with tariffs against those actors and trading partners of the US that do take the most advantage of us, and that is Japan and Europe. But you haven't heard a peep about those. It's all about Canada and Mexico. And look, not to belabor this, and then I'll shut up. His main his underlying MO for all of this, Cali, is what the New York Post famously had as a cover a couple months back, and I've even referred to this, called the Don Rowe Doctrine, a takeoff of the Monroe Doctrine. He is very much of a mind that there needs to be a reordering of the world. We're going to be in a multipolar world where the U.S. is not going to insert itself everywhere, and that's one of the things I stand up and cheer about, that the president understands that. Um, but as part of that and as part of being even closer and meeting more of our needs regionally with Canada and Mexico and South America, the old saying is you draw more flies with honey than you do with vinegar. And I think starting out with this, heavy-handed approach when it's not called for, isn't good. I mean, it's good for you because this has woken up Canada as an election looms up there to realize, holy cow, maybe we shouldn't have shut down all these pipelines and projects and so forth, during Justin Trudeau's time. We better get our own act together. So maybe he's done a favor for you through the back door, so to speak.
I 100% agree that it's a favor to Canada because it feels, yeah, we're asleep at the wheel for way too long. The Financial Times just came out with an article that how mineral rich Canada is, and we do nothing about it. So in the long term, I do believe the tariffs were a great wake-up call because again, we've had the slowest permitting. We've
Yeah.
just been dragging our heels on almost every aspect of the ways that this country can make money. I guess the wild card is what's going to happen with our election. What do you think the reaction is going to be from the states if we keep our liberal government?
Well, first off, one of the things that kind of annoys me and a lot of my friends in Canada is that Trump's antics have turned this into a two-way race. A couple months ago, even with a quote seasoned politician like Mark Carney as a stand-in and standard bearer for the liberals, this shouldn't have been a close call for you up there. And some people tell me it still isn't. I mean, Polyev was ahead, what, 27, 28 points in the polls not long ago, and now you take the two off of that. And it's a 7 or 8 point difference, I believe. Correct me if I'm wrong, but in the national polling up there. So, I hope that President Trump has not been single-handedly responsible for keeping Canada in the hands of the liberals, partly as a reaction against him, because I know darn good and well that the propaganda against Polyev will continue to be that we already have one Trump in North America, we don't need another one. And he has done, and our Trump down here has done a lot to poison the well up there. And I think that's regrettable. And I hope that he has not harmed Polyev and the conservatives too much in Canada, because that would, of course, be a more natural ally and natural fit for the U.S. And I don't think Carney should be able to get away with whitewashing his history either. He's
100%.
he and Justin are two peas in a pod, really. But we'll see. I mean, Trump has not done you a favor in that regard when it comes to turning what should have been a runaway into a horse race potentially. To your point a minute ago, on that FT article, with the mineral wealth that Canada has, much more disproportionate compared to the U.S., you should be dictating to us and to other potential trading partners on supplies of nickel and copper and cobalt and lithium, especially uranium, oil and gas. You should be much more a driver of your own destiny than having to react as has unfortunately come about.
I love that answer. It feels very far away, but I do love that answer. With the liquidity, it looks like there's a little bit coming back into the markets after, almost the worst market since 2022, a couple of weeks ago. Do you think with the Fed announcement tomorrow, we'll see an increase in the liquidity side?
Well, look, I think there's lots of liquidity in the markets. The way that I've characterized what's been going on the last several weeks, though, Callie, is that we have a repricing, a recalibration of a lot of the stock market and asset classes going on right now. And I don't think the Fed is going to react to it anytime real soon. I don't believe they're going to lower interest rates tomorrow afternoon. And they will again use as an excuse, at least in part, that they got to wait and see how Trump's tariff policies shake out when it comes to inflation and what it does to costs and things like that. But look, on average in the US markets, there's at least a 10% correction roughly once a year. We haven't had one since the fall of 2023, so we were overdue. And the market, by every measure, was overpriced, not only based on its own fundamentals or lack thereof, as the case may be, but also compared to markets around the rest of the world. And so, very abruptly, in the recent past, you've seen the S&P 500 go from 22 PE ratio, I'll get it right yet, uh, to 20. All right. Number one. Number two, you've seen in the last month, as Bank of America covered this morning, a historic shift. I mean, it's not cataclysmic by any means, but a big shift out of overpriced US stocks and back into Europe and some emerging markets, even China, where just on relative terms, the valuations are less stretched than they have been in the US. So I think that my characterization is we're going to ratchet downward in the stock market for a while. I think that when all is said and done, 2025 will give us a year like we had in 2022, where we had a 20% drop in the S&P 500, about a one-third drop in the NASDAQ. We could match that more or less this year, but it won't mean that the world has come to an end. It won't mean the markets are liquid. It will mean that we started from a place that was stupid when you look at some of the valuations at the peak of the S&P and the NASDAQ. And as a benefit, and this also happened, as you remember, in 2022, as a benefit, there will be some sectors that do well as the money comes out of the areas with stupid prices and into the areas with stupid prices and completely the other direction, that they're just too cheap. And I think some of those will be commodity stories. Some of those will be precious metal stocks, the ones that deserve it, as they catch up finally to the moves in gold primarily and silver secondarily. So I think it's going to be a great year for stock and sector pickers. If you're a passive investor in an S&P ETF, you're not going to have a good year.
That kind of leads into my next question because it feels almost like the perfect setup for the commodities and the junior miners as we progress through the year. Even the liquidity in Bitcoin and people are taking their money out of the crypto space. The Mag 7 are meh, just to
Yeah.
be polite.
Well, now
So
they're the lag seven.
I love that. So it feels like, obviously this money's going to have to go somewhere, and I would love to obviously see it go into the commodity space and junior miners, which have been sitting patiently for many years now. Speaking that you just mentioned about uranium and natural gas, with the tariffs, do you feel like that's a long-term play, short-term play for like the energy side, or what are you thinking, like short-term versus long-term on both those?
With both natural gas, and I'll even throw crude oil in here because it's too cheap right now. It's overreacted to the downside, in my opinion. Unless you think we're going into a depression, then for a while, all of these things will be down. But uranium and natural gas, to me, first and foremost, have nothing to do with tariffs. They have everything to do with the fact, instead, that demand for fuel, for energy, for electricity around the world continues to grow strongly every year. More so now with AI centers, with other data centers. The cryptocurrency mining used to be what was the big, marginal new demand part of the equation. That nobody even talks about that anymore because all of the AI stuff and that ingredient is just so much larger than even the demand on electricity for cryptocurrency. So, you know, uranium is the single best setup in the world, I believe, for any commodity because the demand side is so overwhelming and the supply is still so constrained. It's idiocy that we've seen the not just the look, when you go from $18 a pound on uranium 5 years or so ago to 105 or 6 whatever it was at the peak early in 2024. Okay, that was a nice run. You're bound to have a consolidation, and that's forgivable. We went down to 80, that looked like the bottom, then 70. Lately we've been more in the mid 60s. That's a gift. In the mid 60s, when you look at the demand setup and how long it's going to take for supply to catch up to that. Uranium, to me, is every bit as bullish today at $65 as it was at 18. Because I think, again, and I probably said this to you before, in a couple of years, we're going to see $200 a pound for uranium, barring a global depression that shuts down a lot of economic activity for a while. Because that's just how strong the fundamentals are for nuclear power generally and all of that. Natural gas, I think, is a close second, especially for us here in North America, where we've got the cheapest and some of the best reserves in the world, including up there, of course, in Canada. and the rest of the world is way higher price for natural gas. You're going to be starting to export more gas from Kitimat before too much longer, and that's going to help the market in Canada. I love a lot of the depressed Canadian natural gas producers and explorers, even more so than those I see here in the U.S., quite honestly. So. I think that those are both going to be great stories. The only place where tariffs are going to impact them is to make energy more expensive here if President Trump goes forward with tariffs specifically on either uranium or natural gas. He's already had to back off some of his bluster. I think he's got enough sense, or some of the people around him do, to know, as he's mentioned already, that he wants to tariff energy imports from Canada at a lesser rate, where I think is hypocritical, and I don't think Canada should let him. If I was a Canadian Prime Minister, I wouldn't let him get away with it either. I would probably do something like Doug Ford has been warning that, all right, fine, you want to do that? We'll start raising costs to people in several U.S. states that need Canadian electricity or Canadian gasoline, and see how you like it. See how your poll numbers look after that happens. But to me, that's when you look at the long-term and broader fundamentals of either the fossil fuels or uranium, tariffs are a sideshow to the much bigger story long term of very strong fundamentals.
I know with PDAC, everyone like the big stories obviously was gold and Gold Explorer. You guys have some of the best nickel deposits, and like what do you think is the long term for? I personally really like nickel, even though it's had its butt kicked. But I personally like that story. What do you think as far as even just in the US for some of the properties? Do you think with the permitting process, we're going to see a big shift in the next couple of years as if everyone becomes independent? Like, do you think those prices with Indonesian supply will change or?
Here's the problem, Callie. And I'm glad you brought up nickel, because I think of all of the base metals, nickel is arguably the cheapest and the most absurdly so right now. And in Canada as well as in the US, we both have some great development stage projects that have gone through some of the, at least of the permitting process. But here's the problem. When you're dealing with a global price of 15 or $16,000 a ton, nothing works in the US or Canada at that number. If you could wave a magic wand and tomorrow all of the development stage projects were all fully permitted, you can't find a labor force, and you can't compete still with the pricing in Indonesia and places like that. So I think that the permitting reform ideas are great, and what's on the table to do that, because a lot of this stuff is just stupid that both of our countries have done for hemming in our own resources for far too long. But this is going to be a very slow process. And the problem, especially, is if we're going into a period of more economic weakness. There's still so much money printing that's gone on in the world and so much liquidity. I'm not in any way, shape, or form predicting a bad recession, let alone anything worse. But when you have that environment, it generally does not argue for upward pressure on base metal prices. It's quite the opposite. So here's where I come down. In the US here, I've been carrying water recently for a public policy initiative of a national infrastructure bank. And it's that and things like that where respectively the US and the whatever the new or renewed Canadian government is, however long it takes to get there, have got to think outside the box and say, okay, we are willing to pay more for good organic local food because we don't want to import food cheaper from other countries. We are willing to pay more for a nice pair of local sneakers if it puts people in Canada or the US back to work. We've got to use that same mentality and say, okay, what public policy and financing positions and even loan guarantees and even price supports are governments willing to look at if they're really serious about saying, okay, we need to get off, whether by choice or because we now have to, because of embargoes against us for some of these metals, and that's only going to get worse as these tariff wars continue. What are we willing to do as a government to say, okay, we don't care what they sell it for in Indonesia because it's dirty nickel, they got human rights abuses, all the environmental practices and so forth. Are we willing to go out and say for US nickel, And is Canada willing to go out and say, okay, for Canadian nickel, we're going to guarantee and operate under the premise that it's $25,000 a ton, if that's what it takes to make these things at least reasonably profitable, get everybody taken care of, and bring this nickel from the US or Canada into US and Canadian markets. Are we willing to do that? Because unless we are, we're going to be in a place like Europe is right now, where Europe has been terrible it allowing anything domestic to be grown, grown or produced there. You've got Rio Tinto's got a big lithium project. There's continual public opposition. Fine, then don't be hypocrites. If you don't want to spend the money and have the pricing and have the work and everything like that within Europe for your EV inputs, then shut up, hold your nose, and stop all the talk about embargoes against China. Let all of the BYD vehicles in because if that's all that matters and you want the lowest cost global producer still, then you've got to import Chinese EVs. End of story.
I
Okay.
I love that.
But until we get to that point in both the US and Canada, we're going to say we don't care what they can sell it for. God bless them. But they ain't selling them for that here. And we will have a second tier, a different tier of pricing in the US, Canada, North America, because we believe in first world labor standards. We believe in first world environmental standards. We're going to enforce those, but that means we're going to have different pricing. And we're going to put the infrastructure in place to make it happen. That's what has to be done because permitting alone does not solve the problem. It only means you can get a money losing mine permitted faster, but it's still a money losing mine.
I was going to ask next actually about lithium because again, I feel like lithium's been beaten up so much too that it's starting to become a story that I actually want to follow again because I'd like to say we've hit close to the bottom prices, but I mean, I don't know, it's too hard to call. But do you think that there is, with these tariff wars and everything changing, that there is this possibility of price protection for spodumene prices or whatever XYZ that might be going forward, that that's actually a conversation on the table?
The only serious suggestion I've heard of that, as far as the pricing, actually came from the presidential candidate in the US on the losing side last November. I doubt she came up with this on her own. She doesn't have the brain power for it. I just got to throw that gratuitous comment in. But somebody on Kamala Harris's team actually suggested part of her industrial strategy would be price supports for things like lithium. So at least they were going in the right direction. I do know that there are both Democrats and Republicans on Capitol Hill that understand this. Frankly, Democrats more than Republicans understand this. They've been the biggest backers by far of the infrastructure bank initiative. But there has to be, look, there has to be something like this because the math doesn't work otherwise. It's that simple. Lithium, I think, is going to be broken for a while. The whole EV industry in this country is on its back foot. It's going to have to digest its gains to this point. It's going to have to compete more on price with the internal combustion engine. You're not going to have the $7,500 tax credit anymore for buying a new EV or the lesser tax credit for buying a used one. That's all being done away with. It doesn't mean that President Trump even wants to outlaw EVs. And this isn't just a gratuitous, you know, gimme for Elon Musk either. He believes, and properly so, that the market should determine, and science and engineering and cost and all of the things should determine how much of an uptake there is on EVs, how much there is on the internal combustion engine. Hybrids, I think, are going to continue to gain market share. You kind of, somewhat overly simplistic to say it, you got the best of both worlds. But I think lithium in generally is partly a broken industry, but partly an evolving one. A funny story from Miami, the Mines and Money Conference. They had a speaker there from the Energy Department that talked about their loan program and what you have to do and so forth. And of course, recently, the Thacker Pass project in Nevada was approved for an over $2 billion loan guarantee to build that lithium project there. And Cali, it's a lithium project that economics and science have both now made obsolete. Nobody in their right mind today, starting from today, would look at that project seriously when DLE projects are advancing with much better science, a fraction of the environmental footprint, Okay, so going forward, the only lithium projects are going to make out, at least for the foreseeable future, are going to be the DLE ones, and by that I mean direct lithium extraction, where it's kind of like ISR production of uranium. You know, you stick different wells in the ground, you pump up the water, you've got a process to bang those things off my desk. I'm getting too animated here. You pump up the water, it's got lithium, you get the lithium separated from it, and boom, there you go. Even a couple of the big energy companies here in the US, ExxonMobil being the biggest name, have invested time and money and helped to some extent a couple of lithium oriented juniors to look at this even where oil and gas are being produced. Because what's one of the biggest byproducts of oil and gas is water. Guess what's in that water when it comes up to the surface? You got to worry about how to dispose of it. Lithium. And if there's enough lithium, you can extract that economically from water at oil well sites. So you've got that. You've got some really good spodumene, hard rock lithium projects. Those are the ones that are going to, be able to be produced. And I think economically going forward, once we get a little bit more of a price recovery. But a lot of these clay projects, the strip mining ones and so forth, I wouldn't touch with a 10-foot pole. I asked this guy when I said, well, I'm not going to put you on a spot and ask you in front of a bunch of people, but by any chance, does the Department of Energy have lender's remorse over after everything, all of the bureaucracy and everything drags along? And now the project is approved for this $2 billion loan guarantee. Do you have lender's remorse over this? And he didn't want to give me a straight answer. He gave me a bureaucratic answer, like, well, these things take time, and yes, sometimes the circumstances change. I guarantee you, no private bank would ever put money into that thing.
I know when I talked to you in December, you said your theory or mantra for the year was, does the math make sense? So, what is some of the math that's making sense to you? I know you talked a little bit about uranium and natural gas, but like, where are you seeing these opportunities on the commodities or energy space? Like, are you looking at the explorers, discovery stories? Are you looking at producers and all these things? Like, as far as looking at the mining markets, like where is the math that you're seeing right now?
Well, look, the math generally favors gold. I think it favors silver more than the market has acknowledged. It favors fossil fuels. It favors uranium. In some isolated areas where you've got unique one-off stories, like whether it's antimony, titanium, tungsten. Those are some commodities that are in perilously short supply in North America for our needs, and I think those one-off stories are good. But otherwise, I think that the math, where it comes to base metals and even battery metals generally, is still not favorable enough. You're going to have public policy and financing changes, like I've been suggesting. You're going to have, I think, a come to Jesus moment on the part of policymakers to, either, again, like I said about Europe, either you're going to put everything in place that you need to reinvigorate your local industries, or just shut up, hold your nose, and buy the cheap imports. This can't be done just with permitting reform. So I think the math favors some of those favorites I've mentioned because of the more extreme monetary or supply and demand things. I'll tell you where the math is going to catch up with the markets broadly, and it already is that President Trump came into office down here with a lot of promises that there's no earthly way he can keep them. Now, that's not unusual for politicians. They all do that. There's no exceptions to that rule. They get into office and realize, like Bill Clinton famously did, holy cow, there's such a thing as the bond market. That if the bond market rebels around, against our policies, we might have to change them. Well, guess what? President Trump is finding that out already, and he's going to find it out increasingly as the year goes on, because we are likely, thanks to what Trump just approved out of the House and the Senate, we are likely to end fiscal year 2025 with a deficit that equals or exceeds the last full year fiscal deficit under Joe Biden. It's not going to it's not going to make MAGA land very happy. It's not going to make the bond market very happy because here again, you've still got a culture in Washington that I think President Trump is sincere, and certainly Elon Musk is sincere in trying to change. But the bond market in the recent past, when you've had a 10 plus percent correction in the S&P 500 at the worst point, closer to 15 for the NASDAQ, you didn't get a whole lot of running to the exits by way of the bond market for that. The bond market yield on a 10-year treasury should have dropped more than it did. And it's rebounded in the last few days as you and I are recording this. So the Fed may impact those with its decision this week. But look, until fiscal houses are put in order, most of all here in the US, the math is going to be very much against Trump's agenda of wanting to cut taxes further, uh, to extend and make permanent his tax cut policies from 2017, to do all the other stuff he says he wants to do, and think he's going to pay with it through deregulation and Doge's efforts and by drill baby drill. It's a fantasy. The math does not work for any of that stuff, and especially on the whole Doge thing. Do you realize? I don't know if this has been covered that much in the Canadian press. Do you realize that for all of these savings, 150 million or 80 million and counting, whatever, that Elon Musk identified with his initial efforts, the Republican Congress and President Trump just nullified every dime of it pretty much with their
Wow.
continuing resolution. And since they can't muster the will and the votes to legitimately cut spending, and they extended all of the spending it very close to almost identical with a few minor exceptions to the levels of last year. They just did away with all of those cuts that Musk identified. They said, okay, well, nice job, Elon, but we can't figure out how to come to an agreement on a real budget. So we're just going to kick the can down the road again to the end of this current fiscal year. And we're going to fund everything at essentially what it was last year. So this guy's wasted his time on the surface, you know. And in the Senate down here, Senator Rand Paul of Kentucky, where it comes specifically to foreign aid, wanted to prove that the Republicans in the Senate even aren't really serious about reducing deficits, because he said, okay, for the moment, let's just pass this measure that locks in the Doge cuts just where it comes to foreign aid. We can argue about the rest of it later. And half the Republicans in the Senate oppose that because they still have a culture that they want all of that U.S. money going to other lands for either laundering purposes or to keep our mitts on other countries where we should be getting out of them. So that's the one area, pardon, that you didn't expect that this answer necessarily, but this is the area where the math is really going to be merciless to Trump and the Republicans, is if they don't show a lot more seriousness about truly cutting the size of government. Interest rates are going to go up, inflation is going to go back up, and by the time we get to the midterms, they're all going to be worse.
Do you want to just talk quickly about that we, with antimony and tungsten and some of these one-offs, as you've mentioned, that we are now going into maybe a cybersecurity and defense market as well as some of the short-term plays? Obviously, there are some correlations between mining and defense and cybersecurity right now with some of the minerals. Canada is going to have to spend money on the military probably the first time in a long time, and a lot of countries as well are looking at that. So do you want to just give some of your thoughts of what you think that's going to be short term, long term as a play?
Long before we started worrying about Donald Trump and then the latest tariff thing, which is already exceeds what he did or threatened to do during, Trump 1.0, the world was already starting to move away from this integrated globalization regimen that we had for most of the time since the end of World War II. And not for all bad reasons. I mean, a lot of this, and this would take multiple separate discussions, Callie, but there are some good reasons why we're looking more toward home or toward our own backyard for a lot of the things that we need, and defense comes with that. The problem is for the U.S., and I think to some extent Canada, we let our guard down for a long time, and it wasn't just sneakers and T-shirts and doodads and cheap Christmas toys for the kids. that we outsourced to China years ago and to other countries. It was pretty much everything, our critical metals, our base metals, our some of our energy needs, a lot of what we that need to be a sovereign country capable of taking care and of defending itself. A lot of that is a technological battle. Now, we still have here in North America some of the best scientists and technical people, but nevertheless, either by theft or by selling some of these things or whatnot, other countries got their mitts on a lot of technology as well. So part of this Make America Great Again, part of this rebuilding the Western Hemisphere and the Don Roe Doctrine and all of this stuff for both of our countries is going to be how do we resource a lot of these more critical materials because where it comes to rare earths, where it comes to magnets, where it comes to antimony used for a lot of technical purposes and even for ammunition, ditto for tungsten, ditto for rare earth magnets. These things all have to come. And part of this is also going to be the whole cyber area. You and I were talking before we recorded about my pending adding a couple of companies to my recommended list for the first time in a while that deal with cybersecurity and things like that, because that is a re-emerging danger in many ways. So, all of these things have to be attended to. And I think these are going to be areas where smart investors are going to focus. It's going to be a while before you can, in a blanket way, as we discussed earlier, say, well, I want to buy all these nickel stocks. I want to buy all these copper stocks and things like that. I've got a handful of those type of stocks on my recommended list that I know darn good and well they're not going to reward us tomorrow, but they're great individual stories I don't want to be out of. But to talk about larger sector exposure, I think those are going to be something, the exposures that come down the road. But between now and then, there are these one-off stories, some which have already been pretty strong investment stories, in antimony and titanium and tungsten and rare earths and whatnot. I think those are good. And I think some of these tech companies, and again, I'm about to add two of them to my recommended list before this week is done, that are looking at how to protect all of our data against things. I mentioned that the whole Doge effort here in the US, the central purpose of it is going to be not just to save money that's being, flushed down the toilet by a lot of federal agencies, but to basically bring the federal government, which is archaic, into the modern world, and that's modern IT systems, modern software, and the modern protection that goes with that as bad actors in the world have different ways to invade data, to breach data. We hear these things in the news every day. And now it's not just bad actors that are doing this kind of thing, Callie. It's people doing it for ransom. Ransomware all of a sudden is a word that's increasingly in our vocabularies. When you've got people that can essentially steal your information without you knowing it, open it, get through the encryption, and hold you hostage until you pay them to get your property back or your money back or whatever it may be. So this is a huge need, and this is not going to go away. It's only going to be made worse.
For your portfolio and your newsletter that you showcase, how many of them would you say are focused on the mining commodity space? And then have you added more like short term on the consumer, or whether that's cybersecurity or biotech, just as we transition through a wild start to 2025?
Yeah, I've got a small number of biotech and medical technology stocks I just added back today, believe it or not, because the stock was down over 20% on news that I thought the market overreacted to. A company called Sarepta Therapeutics. It is single-handedly the most profitable recommendation I've ever made to my subscribers in now 29 years of the National Investor. If I added up all of the gains from trading in and out of this thing, holding it for different periods of time, the gains from that one stock, believe it or not, exceed by a factor of two every single losing speculative stock I've recommended and had to eat. That's how big a story this has been. So I've got a few companies like that, a couple others, in different industries, a lot of meat and potatoes stuff. I tell people that you need to treat your portfolio as an ocean liner, not as a jet ski. And you want to have it headed in the right direction. Sometimes you course correct, but I've never been one to go all in on stuff. One of the reasons why our subscribers have done better than those who follow a lot of the resource specific or resource centric newsletters is that if all you did over the years, and it's been quite a while now, was invest in the best stories of junior stocks, even after this move in gold, you're still down 50 or 60 cents on a dollar, hoping one day to get even.
Yep.
When you stay out of those things, or you're more selective, now you've got a whole portfolio and then some to go forward with. And that's always been my mentality. So I would say right now, and I also augmented this morning our gold and silver holdings, both because technically both of them are acting just too strong to not be even heavier in than we were before. So we're probably up to a good 20 or 22% exposure when you look at all the individual stocks and ETFs just on gold and silver. Old energy is probably about that as well. If I throw into ETFs, a really good place to be, even now, with as weak as oil has been. The pipelines, the master limited partnerships, the midstream companies that get the oil and gas from point A to point B, they have been cash machines now for the last few years. And I mean, you're talking about, the total return basis 30 and 40% gains per year, even when the market was going down in 2022. So those are great places to be. I've got a handful in areas of base metals. I've got a couple stragglers left as far as lithium are concerned that I think are good enough individual stories. I'll be patient during this downturn. So, we're spread out quite a bit. I never recommend to be all in one place. And if I had to look at one spot, I think I alluded to this earlier, where the market just doesn't understand how strong the story is when you look at the magnitude of the recent correction. The better uranium stocks out there, you can close your eyes and buy them right now and put them on the shelf in 3 or 5 or 10 years. You're going to be really happy. It's ridiculous the extent of the correction that we've seen in this area that's just not justified.
Everything keeps changing. It's like a weekly, what the Fed says, what Trump says, whatever
Yep.
happens. It's really, and like you said as well, gold is not even following traditionally what we've seen. It just kind of runs on its own. So, can you walk us through how your newsletter works and like the levels for subscribers and just some of the like information they get to just kind of help? Because I feel like you definitely need help in these in these markets.
Well, the model that I have, thank you for that, Callie, at the National Investor is you can get information anywhere, but here you get knowledge. And I think what's important to do is to find somebody who you can trust who doesn't start with a political bias, doesn't start with even a bias for or against a sector. But there used to be this TV show on in the US years ago called Dragnet. And Sergeant Joe Friday was always famous when some witness was rambling on. Just the facts, man. Just the facts. So I want to look at just the facts in front of me. And if it's favorable to go, I was shorting gold stocks for a stretch as recently as last fall when we had a pretty good correction. And I quickly abandoned that when it looked like Biden was still hell bent to get us into World War III with Russia before he left. And so that ended what the correction was that we had in gold last fall. So I'll go either way depending on what circumstances and the markets and sentiment and everything are telling me. So the one thing I can always promise people is I don't start from a position that gold always has to go up, that I always want to be in gold, or that anything does. You've got to be able to look at the landscape out there and make a judgment. And that's why, as I alluded to a few minutes ago, we've got a fairly broad portfolio. I don't believe in being too broad just for the sake of being diversified. You've got to be in different areas. But right now, we've probably got our highest position since 2022 in inverse ETFs that bet against the broad market. Because I do, as I said earlier, think that we're going to have a bear market this year when all is said and done. But at the same time, I'm long those areas like uranium, like precious metals, like some energy and individual stories in biotech and cybersecurity and whatnot that I think will not only do well because of their own merits, but when you have a broad bear market, they do better during a time like that because all of a sudden the passive game doesn't work for investors anymore. And when the broad market is going down, they, gee, not, you mean I've got to be an investor again and look at fundamentals? and look at stories and not just close my eyes and buy a passive ETF and think, that I'm going to live happily ever after. That's the world we're going back into again. And we really haven't had that since 2022, but I think we've got it again now. So I really think that well-positioned investors are going to have the best of both worlds. And that's what I try and give folks. So if you go to nationalinvestor.com, you can get my free newsletter, which gives general commentary and whatnot. And for a lot less than other people charge, the prices are going to go up shortly, so you don't want to wait. You can get a really good deal if you click on subscribe or renew now and you want to get all of my recommendations. And I'm putting out stuff, you're on my mailing list, so you know this, whether it's general stuff or stuff, even for my subscriber only stuff. On an average of once a week, I'm sending something out, whether it's a new recommendation, modify this, modify that, whatever. I'm not a day trader. I don't advocate that, but I do think you need to keep up with the events and where you can get away with it, anticipate events too.
What is your favorite math as far as picking like across the board? Because obviously you looked at all different sectors. Is it the management that makes the most sense to you? Is it share structure? Like what are
Oh
your
God.
key qualities that you look for across the board?
There's a lot of things. I think if I had to boil it down to two, and I don't like to do just this, but management is big. Okay. I love, and I sometimes refer to it when I make a new recommendation or I'm doing a special tutorial for subscribers or, potential subscribers. I love my bet on the jockey theme. So, Ron Turcotte was a great jockey. Yes, he rode horses that should have won, like Secretariat and Riva Ridge, but he was a good enough jockey that he also led other horses to wins that where maybe he was the difference. So you want to look at the jockey, look at management that isn't taking exorbitant salaries or blowing money on stupid stuff, but and also that has a track record. You've got a handful of people out there, even in a lousy market for junior resource stocks in recent years that can raise a lot of money just on their name. Wherever they're going, follow them. And I do follow some of these guys more than once. And aside from that, I think you have to look at how, and this has been a particular hobby horse of mine recently, Callie, especially where precious metal stocks are concerned. There are good reasons why the move in gold to 3,000 an ounce US has not lifted all boats, nor should it. We're in a different world right now in a lot of different ways. On my own YouTube channel, if I could make a quick plug, I did a podcast recently called This Is Still Not Your Father's Gold Market. Listen to that if you can, folks, because it tells you all the reasons why you need to be a lot more selective. There are a lot of gold stocks I cover that have done very well recently, and there's others, even ones that I covered, that have not, that have still been kind of stuck in the mud. I think it's unfair in some cases. I don't question as much in others. But people who are going to move the needle today, and let's give you this as a takeaway, gold bugs are not going to cause gold stocks to catch up to where we all think they should be right now. It's going to be generalist investors that come in who just can't ignore this anymore. And you got to ask yourself, where are they going to look? Sexy drill results, grab samples, which are reported very disingenuously by a lot of companies, all this kind of stuff that makes the heart palpitations come for the dyed-in-the-wool gold bugs. They don't mean anything to the generalist investor who's going to come in and start to move the needle for you if you're already in one of these kind of stocks. When they see cash money, okay, they see a great economic study that, okay, drilling is one thing, but these guys can make a lot of money on this damn thing. Okay, look at the US gold. I just want to throw that one out there. Look at the US gold. Look at their stock price, which still is woefully undervalued, but they've done better than most of their peers. And it's because the economics are incontrovertible of a really nice project they've got in the state of Wyoming. And that's what people are going to look for. So exploration stories are nice. I've got my share or more than my share of them. But what's the end game, cash flow wise, revenue wise, and what is going to turn on a generalist investor that we need to come in to make our bets go higher? What do they want to see? And it's show me the money. So that's why the markets have not rewarded the pure exploration stories that really aren't close yet to having anything economic, let alone producing anything economic. If they get to that point, then they'll start to move as well. But that's how these markets have changed. You just don't have the constituency, numbers wise, of investors these days that are willing to put money into these early stage companies. Some of us do. I do it. You do it. Our respective followers might do it. But you're going to have to be patient with some of them, even the better stories, until they get to that show me the money stage. Because the investors who are going to jump in next are the ones who want to see that.
Well, that does it for today's Exploring Mining podcast. If you'd like to be a guest or sponsor for this podcast, please contact InvestorIdeas.com. InvestorIdeas.com reminds all listeners to read our disclaimers and disclosures on the InvestorIdeas.com website. All investment involves risk, and this podcast is not meant to be an endorsement to buy or sell securities or products. To hear more podcasts, you can go to InvestorIdeas.com/audio. And a reminder, you can also hear our podcasts on iTunes, Spotify, Google Play Music, iHeart.com, TuneIn, Stitcher, Spreaker, and SoundCloud.